quite cautious category. Jamie Dimon, the most important banker on planet Earth, I would say. We know our affinity for him, different. With that said, I've been in the same camp for a while. Obviously, the market hasn't until today, or at least the last couple of weeks. And we've thought for a while at a certain point interest rates are going to matter. Well, it turns out they matter seemingly north of 4.3% in the 10-year. And rates continue to grind higher. And it's for all the wrong reasons. And I think there's this sort of recalibration going on in the market that, frankly, is quite healthy, but it's going to be, I think, a little more painful than it's been.
We were just chatting in the green room about the call from Andy Constant back in August, mid-August. That was around the time, that was the time of the Fitch downgrade, also when the BOJ started tweaking its policy. And in the meantime, we're facing now a government shutdown, slightly different, but sort of the same kind of thing. It emphasizes government dysfunction.
Right. Government dysfunction.
And Moody's getting more cautious.
And also it was the amount of treasuries to be issued was going to be enormous, and that they would have to go further out the curve. And so you would start to see interest rates out the curve rise, which it has. That was an excellent call by Andy Constant. I think that all of those things still exist, right? It's interesting because we have this idea, oh my God, rates are so high. They're not even at historical, not even a historical average. So it's been certainly an adjustment. I think there's a little more adjustment to go. I am always long. So, weeks like last week and this week is starting out really not delightful. But I think we're more than halfway through this. And I think not all stocks will be hit equally. We talk about the high flyers, super high multiples. I think those have been getting hit, as they should. I think those still have a little ways to go. And, it's painful, but I'm sticking through it.
Well, the warning signals for this market are that Apple and Microsoft are both through those levels we were talking about, 3 weeks ago, and where they held and they were heroic and et cetera. And as you talked about, we don't spend as much time talking about the Dow. It's not that we're picking on the Dow, but I think there's reasons why the Dow is less significant than the S&P. The fact that the S&P has now decidedly traded through the 100-day for the first time, really, if you take out SVB, which I think at least for this compare, we're talking about the broader market, broader rates, dynamics that are not necessarily idiosyncratic around the banking sector for now. And it's a dramatic move. We haven't really seen this kind of move through the 100-day on the downside since going back to late last year. And if you think about where we have some of the big cap tech stocks actually setting up to go lower, I think 4170, 4150, which is a really interesting level on the S&P, is not going to be that difficult to get to. And I think ultimately it sets you up really nicely for two of the best seasonal months of the year. I think the rates dynamic has to work itself through. There's a lot of anxiety. There's a lot of math involved here that doesn't make sense. But, look at the VIX. The VIX for a long time was trading at essentially or post-COVID lows for, really through some of the first phases of this move higher in rates. And it's extraordinary. Small cap stocks are basically on a relative 5-year low to the S&P. And they really are one of your big barometers of growth and whatnot. And that doesn't look so good.
It's funny. If Jamie's cautious right now after everything that we've been through and some of the warnings that he's had. He was out, I think, 4 or 5 months ago saying, hey, be prepared for much higher interest rates, right? So now that he's going to the top end of that band that he had guided to a couple quarters ago, when you think about it, 7%, you think about that on a historical basis, Karen, and you mentioned that we haven't seen rates this high. We still have inflation really high, right? And that's kind of the point. So if you look at what real rates are right now, it's not really that restrictive. And we have a time where, the consumer's not doing well. We're talking about it last night. Look at, I guess if you just want to look at it through the lens of small caps who are kind of most sensitive to this kind of rate, they closed, the IWM, the Russell 2000 closed flat on the year right now, right? If you look at the equal weight S&P, we look at that through the lens of the RSP. It closed flat on the year. And that thing, this is really important to Tim's point about some of these big mega cap leaders that were, we've been talking about this all year. They've been concentrated. They've been driving a lot of the performance. Look at that RSP chart. If you look at it on a 1-year basis, it made a double top just a month ago. It's down about 10% now.